All right. So here we are with the continuation of our last series based on the book The Disciplined Trader. So far we have already covered around 15 chapter and 16 chapter also we covered halfway through. Like we have already gone halfway through it. And today we are on step 5. So till step 4 we have already covered in the last video itself. So in case if you have missed it, please go and watch it to get the better understanding of these videos, and they are very important to have a great understanding of my market psychology and your psychology as well, right? How exactly it works. So let's start with step 5. Today we are going to complete this book because there are only around 184 pages, right? So there are only 7 to 8 pages left. So let's cover it. Okay, let's dig right into it. So step 5, learning to think in probabilities. After you have mastered the more fundamental skills, in other words, once you have, okay, let me just mark the arrow over here now. Hmm. Okay. After you have mastered the more fundamental skill, in other words, once you have acquired the discipline necessary to interact with the trading environment effectively, you can start to use your reasoning skills and intuitive powers to determine what the market is likely to do next. This will entail learning to think in probabilities. What I mean by this is, if you can't personally move the market, then you will want to be able to identify the group that is demonstrating the greatest possibility of moving the market, and you will want to trade with that group, or you will want to determine the prevalent beliefs being expressed in the market and how those beliefs will affect price movement. The identification process requires a detached objective perspective where you are watching and listening to what the market is telling you instead of being focused on what the market is doing. Right. Okay. Now, hmm, market is doing to you personally. All right. Okay. On page number. Okay. And we are here now. All right. Hmm. Okay. Instead of being focused on what the market is doing to you personally, remember two traders willing to trade at a price make a market. Whatever the extreme ends of human expression are in what the market is capable of doing. For example, have you ever heard the market can't break contract lows? It's never been there before. If you bought those lows based on your belief of its impossibility, then consider that all it takes is one trader who is willing to sell lower to make you wrong. The fact that market did it makes it right. You could have been a seller all the time lows and uh, at seller at or at the all time lows, and been a one tick winner when the next trader broke these laws. If you could have perceived selling as an opportunity. Okay. If prices were to penetrate those laws with any kind of follow through, it would indicate that there are plenty of traders who believe it wasn't going higher. These sellers obviously acted on their beliefs with enough force to outnumber the buyers available to take the other side of the trade. Regardless of the criteria the sellers used to justify their action, how rational or irrational by anyone else's standards, nothing will alter the fact that the market traded lower. The fact that you believed it couldn't do it is of no consequence unless you can trade big enough number to reverse it. Otherwise you can either be with it or against it. To help you learn how to be with the flow of the market, I pose a series of questions that are designed to keep you focused in the moment, in the now moment, to determine what is true about the market. Okay, the first question: what is the market telling me at this moment? Who is paying up to get in or get out? How much strength is there? Is momentum building? Can it be measured relative to something? What would happen to indicate the momentum is changing? Is the trend weakening, or is this a normal retracement? What would show that if the market has displayed a fairly symmetrical type of pattern and that pattern has been disturbed, then it is a good indication that the balance of forces has shifted. Are there any places where one side will definitely gain dominance over the other? If that point is reached, it still may take some time for the other side to be convinced that they are losers. How long are you willing to give them to stampede out of their position? If they don't stampede out of their position, what will that tell you? What did traders have to believe to form the current pattern related to the past? Remember, remember that people's beliefs don't change easily unless they are extremely disappointed. People are disappointed when their expectations aren't fulfilled. What will disappoint the predominant force? What is the likelihood that happening? What is the risk of finding out in a trade? Is there enough potential for the moment to make the trade worth the risk? We may never know what traders will in fact do, but we can determine what they will likely to do if certain things happens first. So basically, whenever you are entering in a trade, no, don't enter in FOMO, right? Give yourself time, give yourself room. Market is not going to, just boom, like go boom all of a sudden, and you will miss an opportunity. Even if, let's say, in some scenarios it happened with you, okay, it is fine. Market will give you another opportunity. Okay, so never be, what I can say, too afraid to lose an opportunity. Do your procedure, ask yourself questions, ask yourself logicality, and then only enter. Ask yourself, is it the right opportunity, or is it just making me feel that it is a right opportunity? So when you will ask questions to yourself, you'll get the answers and you'll get the clearer idea that you can take this risk or no. Okay, so these are the questions. You can take screenshot of it, or you can just write it down, or at least try to go through it at so whenever you are trying to enter in a trade. Okay, once or twice if you'll go through this list, most likely you'll end up asking yourself these questions, like they will become the part of your subconscious mind, and whenever you are in similar situation it will come out automatically. So yeah, this can happen to you, right? We may never know that traders will in fact do, but we can determine what they will likely to do if certain things happen first. For example, if traders push the price lower than the previous low, what will likely occur? Is this the new low significant enough to cause traders holding long position to bail out? Will it cause new shorts to enter the market or attract existing shorts to add to their position? New shorts may be attracted to the market. The old shorts will add to their position. This price slide will stop when enough traders believe the price is cheap related to something. That reference point will likely be some other previous old or low. If you can't determine the significance of any particular high or low, or any other significant reference point for that matter, then you have to ask yourself if it is worth the risk of finding out how much room will you have to give the market to define itself before it is evident that the flow of the market is not in the direction of that trade. Ask yourself this question: for this trade to be valid or continue to be valid, the market shouldn't trade to that point. To what point? If it trades within that point, then the trade still has potential for working. Beyond that point, it is no longer valid in the direction that I started. Okay. Keep in mind that the amount of price movement that you determine is necessary for the market to define itself has to correspond with your emotional tolerance to accept the dollar value of a loss that size. Otherwise, don't take the trade regardless of how much potential you think it might have, unless you can realistically change the foregoing parameter to fit your capacity for a potential loss. Very important, right? When you feel FOMO, don't enter because you are only seeing that the market is going to go in your direction. But what if it will go in the opposite direction? Do you have the clarity when exactly you are going to get out of the trade in those conditions? Let the market define itself and then apply whatever criteria you use to define as an opportunity. Okay. Identify your significant reference point and place your orders on either side of the point. Then wait for the market to do whatever it is going to do. Try putting your orders in the market in advance of whatever you perceive as having a high probability of occurring. Very good, very important. So rather than trading on market price, you can put advance orders to be filled in. Try putting your orders in the market in advance of whatever you perceive as having a high probability of occurring based on the existing market condition. By putting your orders in advance of some anticipated move, you will be learning how to let the market work for you. Placing your orders in advance will also help to keep you from having an opinion, and you won't be subjecting yourself to the moment to moment conflict between inherent within all price movement. Keep in mind that since the market is in perpetual motion, it puts you in a position of having to make never ending assessments of the current risk in relationship to the current possibilities for reward. To do this effectively, you will have to learn to observe the market as if you were not in a position. This perspective will free you to take whatever action is appropriate for the situation instead of hesitating, hoping and wishing for that the market will make you right. Very important. When you are in a trade, no, then your profit and loss is affecting your psychology. So rather than getting affected by it, try to see it from the third person's perspective who is not in the market itself. Then try to objectively gather all the information from the market and then take the well assessed judgment or well assessed step without any hesitation. Otherwise, if you're just hoping, then even if because of the hope you'll be in the right direction, in longer run it'll be problematic to you. Happened with me. So yeah, the market doesn't make you right, you make yourself right. Your inability to execute or the degree to which you hesitate after you perceive an opportunity to get in or out of a trade or reverse your position will be an excellent gauge as to how locked in you're mentally. Making note of these occurrence of hesitation or immobility will give you an indication of the exact state of your mental resources to execute. You need this information to use as a reference point to build from. Important stuff. When you are about to enter into a position, ask yourself by imagining what the next 5 minutes or tomorrow, depending on your time frame, would have to look like to validate your trade. To confirm that the trend is still intact, what would the next 5 minutes or tomorrow have to look like to indicate the opposite? Then again, place your orders at the appropriate price in advance of the markets getting there. Super order. So these things are very important. And if you can do it, that's better. All these questions will keep reminding you that anything can happen and you'll be preparing yourself in advance for those possibilities. Also, if anything can happen, then of course you'll have to consider that there will always be something you haven't taken into consideration, had absolutely no awareness of, or could have no prior knowledge of. For example, such as how many traders may enter the market for the first time with enough force to reverse its position. Keep in mind that prices move in the direction of the greatest force. Traders fulfilling their belief about the future, or said in its converse form, prices will move in the direction of the least resistant to the prevailing force, right? Significant reference points give you the opportunity to make high probability assessments of the degree of the degree of balance or imbalance between the two forces, the point at which it is likely to shift, and in whose favor. By learning to identify significant reference point, you can determine what each group will do based on what they already believe about future value. If you can determine on a collective basis what will validate or invalidate your beliefs, then you will know how each group is likely to behave. I want to remind you that this approach is to help you stay detached and understand that price movement is a function of traders acting individually and collectively as a force expressing their belief in future value. The greatest number with the strongest belief will always be right. The easiest way to make money is to go with the flow. To identify the flow, you need to stand apart from the crowd and suspend what you believe about relative value so that you can determine who is likely to do what and with how much force. How is everyone else likely to react? And if it doesn't happen, what will traders do then? So try to observe the market from third person perspective is the basic idea that we are trying to prevail over here. Who's likely to do what with how much force? How is everyone else likely to react? And if it doesn't happen, what will traders do then? By asking yourself these questions, you are automatically keeping your focus of attention on the market and what the possibilities are. Any limitation you place on the market's behavior will cause you to force on the focus on the impossibility instead of the possibility of something happening. Your belief that the market has to behave in a certain ways prescribed by your mental structure will cause you to focus your attention on that, on what the market is doing to you. And if what it is doing is causing pain, then the potential exists for you to avoid or distort information, usually resulting in a painful forced awareness. Step 6: learning to be objective. To achieve a state of objectivity, you need to operate out of beliefs that allow for anything to happen, as opposed to beliefs that allow only for the market to express itself in a limited fashion. If you operate out of a belief that anything can happen, then whatever does happen won't be threatening to you in any way, thereby causing you to avoid or distort certain categories of market information. Any limits you place on the market's behavior will be compensating factor for your lack of trust and confidence to act appropriately in any given situation. This will be evidenced by the fear, stress, and anxiety that you will feel when the market expresses itself beyond your mental limits and you can't do anything to control the situation. However, you do have to have some belief or expectation about the future, or you wouldn't ever put on a trade in the first place. To be objective, you'll need to release yourself from demand backed expectations and make what I call uncommitted assessments of the probabilities. Unlike the markets in our everyday social lives, we can and do exert control over the environment to assure ourselves of the outcomes that we desire. The rules we learn to abide by in order to interact with one another are our expectation about the future. Once we learn these rules, especially if we have learned them in a painful way, we can demand certain outcomes from the environment. Hence, our expectation of the future are actually demands that the environment conform to our expectations of it. Without really thinking about it, we will carry these same kinds of demands with us into the trading environment because of our natural resistance to letting go of our expectations. That is, staying committed to any limited belief about the possibility that exists in the market is virtually the same as making a demand. If you have any doubt about this, consider that if we weren't demanding that the market conform to our expectation, then we wouldn't ever have a reason to get angry when it doesn't. Have you ever gotten angry at the market? Anger is a natural defense mechanism. When we feel anger, it is an indication that the environment is assaulting us in some way, creating an imbalance between the mental and outer environment. The outer environment is either showing us something about itself or ourselves that we don't want to accept. We protect ourselves with our anger to ward off this assault. In our everyday lives, our anger can be an effective tool to get what we want, change what the outer environment is showing us about itself that we can't accept, or to ward off what the environment is showing us about ourselves that we can't accept. However, if we interact with the market with demand backed or committed expectation of its behavior, we will cut ourselves off from the information that we need to take to make accurate assessment of its potential to move in any given direction. If we don't have the power to control the markets in such a way as to make them to do what we expect them to do, and at the same time we aren't willing to give up our expectation and accept the way things are, then it would create what would otherwise be an irreconcilable irreconcilable, conciliable, irreconcilable, irreconcilable dilemma. If it weren't, if it weren't for our ability to distort, alter, or exclude information from our awareness, perpetual distortion is the one compensating factor that will at least temporarily correct the imbalance between what we expect and what the market is offering, where there is a difference between the two. Our committed expectation about the future will act as a force on our perception of market information to control its flow into our mental system in such a way as to avoid a confrontation with anything that doesn't confirm with what we already believe is possible, which of course is always going to be less than what is possible from the market perspective. If we are perceiving much less than what is available, then we are out of touch with what is possible from the market's perspective and setting ourselves up for a painful force awareness to be objective. You have to make uncommitted assessment of the probabilities, which simply means that you have no commitment to any particular outcome. You just observe what is happening in each moment as an indication of what will probably happen next. Here is what objectively feels like, so that you can recognize when you have achieved it. You feel no pressure to do anything. You have no feeling of fear. You feel no sense of rejection. There is no right or wrong. You recognize that this is what the market is telling me. This is what I do. You can observe the market from the perspective as if you were not in position, even when you are. You're not focused on money, but on the structure of the market. To stay objective, anticipate as many possibilities as you can and how probable each of these possibilities are. Then decide in advance what you are going to do in each situation. If none of your scenarios is working out as you anticipated, then get out. Release yourself from the need to be right. The more uncommitted your assessments are, the less potential for distortion and experiencing a painful forced awareness. Step 7, learning to monitor yourself. As outlined in the exercise to develop self discipline in chapter 14, you need to start paying attention to what you are thinking about and what market information you are focused on. Trading rules. When you are in a trade, constantly ask yourself if anything has to happen. Obviously, you want the market to go in your direction. However, what I want you to do is monitor how you feel, your level of commitment to what has to happen. Remember, there is a big difference in perspective between what is happening and something that has to happen. If you find that your commitment levels are rising, keep on telling yourself that it is all right for anything to happen because you are confident in your ability to respond appropriately to whatever does happen. Ask yourself, what can't happen, what can't the markets do? When you find yourself rationalizing the market's behavior to support your position, you're operating in the realm of illusion and setting yourself up for a painful forced awareness. Remember, the market can do anything, even take your profits away if you allow it. Always take something out of the market when you find yourself in a winning trade. Much needed. So it happened to me many a times. I've seen the market going in my direction and it moved up to 10% or so, and then it took all my profit and then it took all the loss. Like it made me lose big as well in the same trade itself. A question to ask yourself is, if you are prepared to give yourself money today, if the answer didn't come back a resounding yes, then find out why before you trade. If you can't reconcile the issue or set it aside, then you would be better off not trading until you do. If you are determined to trade anyway, at the very least, make a substantial reduction in the number of contracts you normally trade. When you find yourself focused on the monetary value of a trade instead of the structure of the market, what the trade is worth to you in dollar terms, streams, goals, and so worth instead of what the market is telling you about its potential to move in any given direction, then assume you are distorting or avoiding certain information, and either don't put the trade on or take what you have off until you become more objective. Much needed thing. So people who have gone through this path have gone through the same kind of mistake. They have committed the same kind of mistakes, it seems. Okay, now we are at the final note. So chapter 16 is already over. So final note, let's say what the author has to say. Even after you have learned all the skills set forth in this book, at some point in time, it will probably occur to you that your trading is simply a feedback mechanism to tell you how much you like yourself in any given moment. After you have learned to trust yourself, to always act in your best, what I can say, your best interests, the only thing that will hold you back is your degree of self valuation. Much needed. That is, you'll give yourself an amount of money that directly correspond with what you believe you deserve based on some value system you acquired at some point in your life. Hmm. How to change that, man? It does happen. The irony is it doesn't happen when you're in a losing trade. The more positive you feel about yourself, the more abundance that will naturally flow your way as a byproduct of these positive feelings. Okay, he's also telling about positive reinformation, it seems. Positive affirmation and similar stuff. So, in essence, to give yourself more money as a trader, you need to identify, change, or discharge anything in your mental environment that doesn't contribute to the highest degree of self valuation that is possible. What's possible? Stay focused on what you need to learn. Do the work that is necessary, and your belief in what is possible will naturally expand as a function of your willingness to adapt. Okay, understood, sir. Okay, so by this, we are coming to the end of this chapter itself, it seems. And yeah, and the chapter and the book is already over. So if I'll give you the index, like I'll show you the index or the kind of content that we have consumed in this series. We started with the general introduction, and then we understood about the psychological perspective, the nature of the trading environment from a psychological perspective, and then building a framework for understanding ourselves. So from this 10th chapter, or sorry, from 11th chapter onwards, I made videos, right? So from there onwards, I have completed till chapter 16. If you need the content that's there before it, like if you want me to make a video around it, I can do that. If you want me to give the summary of the whole book itself in my words, I can do that as well. Okay, so whatever is required, just post it in the comment section. I'll look into it, and yeah, you'll get the desired results. So ask universe what you want, and universe will respond in one way or another, right? So you have to give yourself more self-worth. You have to give yourself more self valuation, because in the market, when you are in the market, when you are in a winning trade, you'll get out of the trade as soon as you feel like, okay, this is more than what I asked for. But that's not the objective way to look at the market, right? You have to take what market has to offer, not just in a winning trade, every time, in all the kind of trades. So even if you're setting target, don't make it too rigid that, let's say, you're just one tick below your target and you're not exiting. Even if the market is shouting at you that, okay, I'm not going to hit your target, I'm going to reverse from this position, but you are so adamant to stay in the position, then obviously you'll end up losing, right? So be a little flexible with it, and be more rigid with your rules and stuff. Like you need to have a good mental framework and a set of rules that you abide by, and also self discipline, more self evaluation. All right, so on this note, let's just end this video and end this series. After this, we'll start another series, or like we'll make another video on another book of Mark Douglas only, and it's called Trading in the Zone, right? And whatever is needed for you guys, you can just post it in the comment. I have said it earlier, I am saying it again. So thank you so much if you have come so far, and you have been, you know, I hope you got some of the information from here. which is going to be helpful in your trading career and in your life also in one way or another. So thank you so much and have fun. Thank you, universe. Thank you, Radharanji. Peace out.